Good afternoon, everyone. Welcome to Deloitte's Public Sector Accounting Standards Update, Bringing Clarity. My name is Rachel Goss, and I'm a partner in our Edmonton practice. I'll be your host for today's webcast. So a couple of items before I introduce our speakers and tell you about our agenda. In the lower right-hand corner of the screen are the webcast links, including a link to download and print today's slides and a few other publications we believe will be useful. You will also find a link for webcast assistance. If you have a pop-up blocker on your computer, you will need to disengage it in order to download the slides or participate in our polling questions. For those of you who know of colleagues who could not attend today's live event, they can simply register at any time for the event the same way you did, and they will be able to view the archived webcast within 48 hours of this event. So please feel free to invite your colleagues to take advantage of this feature afterwards. In addition, although you're only in listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and clicking Submit. We'll do our best to respond to your questions and comments during the presentation. We also have interactive polling questions that will appear throughout the webcast on your screen. Again, we invite your participation by simply answering these questions on your screen. A summary of the results will be provided on screen shortly afterwards. So let me now introduce our speakers and discuss the agenda. We're joined this afternoon by three speakers who will be facilitating the webcast: Lynn Pratt, Matthew Colley, and Cindy Veinot. All of our speakers have significant experience with public sector accounting standards. You can read full bios of our presenters and access the agenda and technical support in the navigation area of your screen. Our agenda for this afternoon's webcast will consist of an update on what's new and upcoming within public sector accounting standards. This will follow by a discussion of the Related Party Transactions Project, PS 3260, Liability for Contaminated Sites, and the Asset Retirement Obligation Statement of Principles. We will then provide some key reminders related to accounting for financial instruments. We will also provide an update on other PSAS projects, along with a discussion of upcoming changes. Time permitting, we will conclude our webcast with a brief question and answer period. We would like to highlight the fact that this webcast does not provide official Deloitte interpretive accounting guidance, and we strongly encourage all participants to consult an advisor before taking any sort of action. So we'd like to begin by asking everyone online to participate in this webcast with our first polling question. All responses are anonymous. Please ensure you disable your pop-up blocker and then select what you view to be the best answer for your circumstance, and then press Submit Answer. So what public sector accounting standard or project is drawing the most attention at your organization? A, PS 3260, Liability for Contaminated Sites. B, Related Party Transactions. C, Asset Retirement Obligations. D, Financial Instruments and Foreign Currency Translation. And E, Other. So while we wait for the results of our polling question, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you may be able to credit yourself with 1.5 hours towards your yearly total. Please check with your provincial institute regarding their CPE requirements. We do not issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. Okay, so let's see the results of our first polling question. Okay, so pretty balanced between liability for contaminated sites and related party transactions, and then, of course, financial instruments. So there will be items of interest to everybody on the line today. So I would like to now turn it over to Lynn Pratt, a partner in our Ottawa practice, who will be speaking on what's new and upcoming within public sector accounting standards. Lynn will also speak on the implications of the Related Party Transactions Project and reporting under the new standard, PS 3260, Liability for Contaminated Sites.
Thank you, Rachel. So let's take a look at what's new at the Public Sector Accounting Board. It's very clear that the board's on a mission to improve standards, which is great. And as a result, we're seeing SOP after SOP and exposure draft after exposure draft. And there's definitely a lot to keep up with these days as a public sector organization. What you're seeing on this slide is the calendar of projects from the PSAB website. The first noted here is asset retirement obligations, and on August 19th of this past year, PSAB issued a statement of principles that addresses the accounting and reporting of retirement obligations associated with tangible capital assets controlled by public sector entities. The comment period ended this last November, and we expect an exposure draft in the second half of 2015. Matt's going to provide a little more information on this SOP later in the webcast, so I won't dwell on that one. The next project is related to concepts underlying financial performance. Now, we expect the board to issue a consultation paper on this topic. The conceptual framework in PS 1000, Financial Statement Concepts, and PS 1100, Financial Statement Objectives, require review with a focus on measuring the financial performance of public sector entities. This review is identified as a high priority in the Public Sector Accounting Board's 2010 to 2013 strategic plan in response to a suggestion from the senior government finance community. The project will consider the concepts underlying the measure of financial performance. The review may result in amendments to the conceptual framework and could also affect PS 1201 that deals with financial statement presentation. The other projects noted on this slide we're going to cover those directly. And so again, I won't address them here with the exception of impairment. An SOP on impairment of non-financial assets is expected in the second half of 2015. Currently, there's a lack of Canadian guidance on impairment of non-financial assets that continue to have service potential. This project will define impairment as well as provide guidance on assessment, recognition, measurement, and disclosure of impairment losses. So moving along the calendar, and in fact the calendar is quite long, the PSAB has undertaken a significant outreach effort to understand the impact of the new government transfer standard. Cindy will speak to various issues identified as critical to the application of this standard. The next project is on handbook terminology, and as you may know, that standard was finalized in December of 2014. The main objective of this project was to clarify that the standards in the PSA handbook are equally applicable to government organizations that follow the PSA handbook as they are for government. The Public Sector Accounting Board proposed introducing the term government component and the term public sector entity. Public sector entity was proposed really as a generic descriptor to be used throughout the PSA handbook, just replacing the word government as a more general term. The changes to the introduction will, however, have a significant impact on certain entities which considered themselves OGOs previously and used IFRS, because those entities are now going to have to transition from IFRS to public sector accounting standards. The other areas noted on this slide, again, will be examined in more detail either by myself or my colleagues. On this last project slide, I highlight standards that are currently final and either being applied currently or will be applicable very soon for government components, or organizations who hadn't previously applied the financial instrument standard under old CGAP or Part 5, as we also know it as. As you can see, there's a concerted effort by the Public Sector Accounting Board to expand and improve reporting by public sector organizations, in particular core governments. PSAB released their strategic planning document last summer, and if you haven't had a chance to see it, I wanted to highlight 3 desired outcomes that the PSAB board wishes to attain over a period of time with their strategy. The first desired outcome relates to producing comprehensive, high-quality, comparable financial statements. The second desired outcome relates to producing comprehensive, high-quality, comparable financial as well as non-financial performance reports. And finally, stakeholders accepting the PSA handbook and other related guidance as a primary source for public sector reporting guidance. We all will have to be the judge of whether they're on track to achieve their desired outcomes. Let's take a look next at the related party transaction project. The consideration of related party guidance under a public sector umbrella is finally here. There was no specific guidance except for not-for-profit entities previously. The PSAS issued their first ED in September of 2012, and it garnered a number of comments relating primarily to the flexibility provided, which didn't necessarily support consistent reporting of similar transactions. The ED, as a result, was re-exposed in June of 2013 and then re-exposed again in April of last year. The latest re-exposure draft divided the standard into two separate standards, one on related party disclosures and the second on inter-entity transactions. The comment period on this standard is now complete, and we're expecting a final standard this quarter. The latest re-exposure draft has clarified that transactions with entities controlled by a member of key management personnel is a related party transaction requiring disclosure to the extent that the transactions have a material impact on the reporting entity. This would also apply to transactions with family members of key management personnel. The re-exposure draft also clarifies that in most cases, inter-entity transfers of assets and liabilities should be recorded at the carrying amount by the provider or fair value by the recipient. Fair value is more representative when the recipient's future cash flows or its capacity to provide goods and services is expected to change significantly. The exposure draft defines a significant change as one that's measured in terms of the impact the inter-entity transaction will have on the risk, timing, and amount of future cash flows and changes in the quality, output, or efficiency of goods and services. That is, when compared with that existing prior to the inter-entity transaction. Finally, the new ED requires that assets transferred from one entity to another be recognized by the provider and recognized by the recipient. Any difference between the carrying amount and the proceeds are recognized as a gain or loss in income by the provider. This represents a significant change in our view. Assuming the asset transfer is not in the normal course, it would in most cases be recognized as the carrying amount of the provider unless the consideration transferred approximates fair value, in which case the exchange amount is used. In situations where there's limited or no consideration, the asset's recognized as a carrying amount unless fair value is a better measure as noted previously. I should mention as well that these new standards must be applied prospectively, although early adoption is permitted. And I use those terms, carrying amount and exchange amount, pretty loosely without having defined them because those are the words that we used previously under Part 5. So I presume that most people are probably familiar with them. But if you're not, please let me know and I'm happy to define them for you. The new disclosure standard includes a wide net for identifying related parties, including control, common control, shared control, as well as key management personnel and family members of key management personnel. There's no need to disclose compensation arrangements for key management personnel, presumably because there are other venues that, generally speaking, provide that disclosure. The new guidance is emphatic around the need to disclose related party transactions where there's a material financial effect only. Materiality, of course, is a matter of professional judgment. However, the standard does not specifically recognize that related party transactions, by their very nature, tend to be more qualitatively material than not, even if they are not quantitatively material. In the new inter-entity transaction re-exposure draft, there is specific guidance to address cost allocation and recovery. Specifically, these amounts must be recognized as the gross amount by the provider and the recipient where there's a policy to do so. In this case, both the provider and the recipient record a gross revenue and a gross expense. There's also a variety of options in dealing with costs incurred by one entity on behalf of another, And I won't go into the details here. If you've got those kinds of situations, I'd encourage you to take a look at the standard. But effectively, the guidance will result in a variety of recognition as well as measurement options in those cases. So let's move on now to contaminated sites, a standard that's been in the handbook since 2010, but is only now effective. So most entities have not yet been through an audit cycle in regards to their contaminated sites. So we'll have to wait and see as to whether or not the points we noted in prior years, and we'll reiterate this year for you, have been taken into consideration. Generally speaking, the standard on liability for a contaminated site applies only to sites or operations that are no longer in productive use. Matt will speak to the concept of productive use in the context of asset retirement obligation, in the context of the asset retirement obligation SOP. However, this standard also applies to an unexpected event resulting in contamination to the extent that the contamination is not related to a specific asset. By way of example, this could include an accidental overflow of sewage into a river as a result of excessive rain, regardless of whether or not the sewage plant nearby is in productive use or not. The standard provided a significant amount of time for implementation due to the significant number of contaminated sites within the responsibility of government. The year ending March 31st, 2015, as I mentioned, will be the first fiscal year to which this standard applies. Given we're so close to that first year end of applicability, we'd expect management to have identified relevant environmental legislation, possible contaminated sites, and develop models to estimate the cost of remediation. Furthermore, the model to estimate the cost of remediation should consider the timeline and a discount rate that mirrors that timeline to remediation, as well as the liability holder's credit risk. Management should also consider how they're going to demonstrate to their auditors the completeness of their assessment. As you know, I'm sure, contamination must be considered in relation to statute, regulation, bylaws, or that kind of law or regulation. As a result, remediation is legally enforceable and binding, and compliance is mandatory. Breaches can be enforced through prosecution, fines, jail, and or loss of permit. Compliance may also be enforced through administrative proceedings. Obviously, contamination has to exceed the maximum acceptable amounts under that legislation or regulation, which obviously drives the requirement to remediate the site or sites. All that said, the scope of 3260 is very open to interpretation. Some view the use of the word such as in paragraph 5 of that standard, as reflected in the first slide of this section, to suggest that these are just examples, not requirements. Those people believe that this standard could apply much more broadly. And just as a reminder of what that paragraph states, this is the paragraph that goes on to say that a liability for remediation of a contaminated site normally results from items such as all or part of an operation that's no longer in productive use, or et cetera, et cetera. That said, the more generally accepted interpretation of this scope is that the standard applies only to assets no longer in productive use, unless we're talking about that unexpected contamination. Matt's going to speak to asset retirement obligations shortly, and we'll cover the situation where productive sites have associated contamination. It's clear from the minutes of the PSA discussion group that there are different possible interpretations of the scope of the standard, and our key message to you is really to consult with your advisors if you're unclear as to whether or not this standard applies to your particular situation. This next slide highlights the difference between asset retirement obligations and PS 3260 environmental liabilities. Many users, especially those who previously reported under Part 5, hospitals, colleges, for example, are familiar with the concept of asset retirement obligation. Recognition of and measurement of AROs is not currently addressed in public sector standards, and so is the subject of that current PSAS project. AROs are different from liabilities for contaminated sites. An ARO represents the cost to retire along with capital asset which is currently in productive use. The difference is in the debit. The liability for an ARO has an offsetting debit to the asset. Under 3260, the offsetting debit is to expense. PSAB is developing a new ARO standard which will address the reporting of obligations associated with retirement of long-lived tangible capital assets. And as I've mentioned a couple of times already, Matt will cover that next. So finally, the scope of the standard excludes a number of areas, either because they're not subject to remediation, such as airborne contaminants, or they're covered by other projects or standards. And that's it on contaminated sites. Rachel, back to you.
Thank you, Lynn. So before we continue on, I'd ask all participants to please participate in our next polling question. So to what extent have you considered the scope of PS 3260 to your organization? A, we have completed a comprehensive review of the applicability of the standard, and our conclusions have been reviewed by our independent auditors. B, we have completed a comprehensive review of the applicability of the standard, and our conclusions are awaiting review by our independent auditors. C, we have only completed a high-level review at this point. And D, we have not yet completed any sort of review, but plan to review in the near future. E, we do not believe this standard is applicable to our organization. So while we wait for the polling results, I do have a question that's come in from the audience. It is on contaminated sites, Lynn, but before I go to that question, I just want to remind everybody participating that you can download the slides in the bottom right-hand corner of today's screen under Downloads and Links. So Lynn, the question that's come in is, in reading the transitional provisions of PS 3260, the standard does not specify if it must be applied prospectively or retroactively. So how should it be applied?
Thanks, Rachel. It's true. If you've read the transition provisions for 3260, there really aren't any. All it says is that the standard may be early adopted. Now, for those of you who are real standard setter gurus, the Public Sector Board produces a newsletter quarterly called PSAB Matters. And back in April of 2013, PSAB Matters addressed that specific question. The application of new accounting standards may be applied retroactively or prospectively. When a change in accounting policy is applied retroactively, you have to, the financial statements for all periods presented for comparative purposes should be restated to reflect that new policy, unless you really can't determine the effectives on any individual period. The cumulative effect on the change of prior periods should be made as an adjustment to the opening balance of the accumulated surplus or deficit of the current period or an earlier period if necessary. When a change in accounting policy is applied prospectively, the new policy is applied only to events and transactions occurring after the date of the change and to any outstanding related balances existing at the date of the change. You don't post any kind of cumulative catch-up except to those balances that exist at the date of the change. So hopefully that answers the question. But again, I'd encourage people to go back to that April 2013 PSAB Matters to, if they need to look more closely at how you apply those new standards.
Thank you, Lynn. Okay, so let's see the results of our second polling question. Okay, so interesting, we have about 50% of the participants that have completed a high-level review or will be starting their review. And Lynn, based on the timelines that you had indicated for the standard, I believe this is likely as a result of a lot of December 31st year ends here that we have participating. So thank you all for participating in the polling question. Now I'd like to turn it over to Matthew Colley, a senior manager from our Toronto practice, who will speak to the Statement of Principles Asset Retirement Obligations.
Thanks, Rachel. So the Public Sector Accounting Board has been eyeing a project on asset retirement obligations for a while now. The project was approved actually back in December of 2011, but probably due to the complexity of the standard and maybe the volume of standards that are being developed and projects that are underway currently right now at PSAB, the project hasn't really progressed a lot since 2011, and really it was only this year where it started to see some significant action from the public's perspective. So some of you may be asking why there is a need for an ARO project and whether this is a topic that requires, urgent or consideration by the board. But when you think about the types of assets that the public sector controls, such as those used in electricity generation, gas generation, like telecommunication assets, transit assets, sewage treatment plants, it becomes quite clear that there would be significant assets in the sector that would be covered by such a standard, and as many of those assets can have significant retirement obligations associated with them, PSAB saw this as an important standard to issue or to get involved with. So in August 2014, PSAB issued their statement of principles on the ARO project, and organizations were asked to respond by November 21st, 2014. So the point of this process is really for the PSAB to ensure that they have the right principles in place before going ahead and fully developing a standard. And so right now, PSAB staff are going through the responses to the SOP, and we'll use that feedback in developing an exposure draft, which will be expected to be issued in the second half of 2015. There isn't a timeline or a communicated timeline in terms of when they expect to issue a final standard, so stay tuned for that. So before I get into the accounting issues around asset retirement obligations, or AROs, I want to take a step back and just make sure that it's clear as to how PSAB actually is defining an asset retirement obligation. So PSAB currently has defined asset retirement obligations as an obligation that is associated with the retirement of a tangible capital asset that is controlled by a public sector entity. So essentially there are three things that need to happen to have an ARO. So the first is that there needs to be an obligation. The second is that the obligation has to be tied to or associated with the retirement of a tangible capital asset. And the third is that the TCA actually has to be controlled by the public sector. So the statement of principles identifies a couple of ways in which an obligation could arise, one being through a legal obligation and the other through constructive or equitable obligations. A legal obligation can be an obligation that arises from legislation, a contract, or agreement, with the main point really being that the obligation to incur costs to retire a TCA is actually legally enforceable and compliance is mandatory. The other way in which the SOP contemplates obligations is through constructive or equitable obligations. And so this happens when an entity or organization voluntarily creates an obligation through its own actions and sufficiently communicates its decisions to incur retirement costs in connection with the TCA. So an example of where an ARO may arise from a constructive obligation would be, if a government promises a community that it will decommission a nuclear power plant and return the site to pre-existing conditions before the asset was constructed. And so that promise to the community could be construed as a constructive obligation because as a resident, that promise will likely cause you to act in a certain manner knowing that the site will eventually be restored. In terms of accounting for asset retirement obligations, and based on what Lynn has said and based on my last slide, it's hopefully clear to you that a liability has to be recognized when there is an asset retirement obligation. And as Lynn mentioned, the good news is that unlike the contaminated site standard, the debit side of the entry actually goes to the asset. Although I guess it could be good news depending on whether or not you're projecting a surplus or deficit for the year. Another interesting point from the proposal was around remeasurement of the liability and how the accounting works for when a liability will be remeasured. So the SOP contemplates that there are two ways in which measurement of an asset retirement obligation can change. So the first is being that there has been a change in an estimate that has occurred, which would affect the financial results of future periods, and therefore the idea is that would be capitalized. The other way is in which measurement can change is due to the passage of time. And that's really for for accounting for the time value of money effect or the accretion aspect of it. And so that's considered to be more of a period cost resulting from operations, kind of like interest expense, and therefore it's treated as an expense, or at least that's what the SOP is proposing. So subsequent measurement could be expensed or capitalized depending on the nature of the change. And as Lynn spoke to earlier around contaminated sites, there certainly are a lot of similarities between the ARO project and the contaminated site standards. But one of the issues that she spoke about from the contaminated site standards was really around the definition of productive use and what is meant by productive use of an asset. And so, while the contaminated site standard is not necessarily clear on what is meant by productive use, or what was actually meant by that term, the ARO SOP has actually come up with a specific definition, and so it's captured the feedback, I guess, that was happening in the contaminated site standard. So the main takeaway from that is really to realize that PSAB is acting upon the feedback that was received around productive use, and hopefully they'll be encouraged to incorporate that feedback into the contaminated site standard itself. Because not every person who looks at a contaminated site standard or dealing with a contaminated sites issue will necessarily think to look at an ARO section to determine what is meant by productive use. An important distinction to make when looking at AROs is the difference between retirement and replacement of an asset. So routinely replacing an asset is not a retirement obligation because replacing an asset is typically a matter of choice. So in order to qualify as an ARO, there has to be a legally enforceable agreement, contract, legislation, or other circumstance such as a constructive obligation that really obligates the entity to incur costs to retire the asset. So for example, replacing part of a sewer system due to its age and useful life is not a retirement obligation. However, if the sewer system being replaced if it ended up being put into a separate location and there were legal obligations with retiring the old sewer system, that would be considered an ARO. So retirement versus replacement will be a difficult concept for many organizations to understand, and so we're hoping that there will be some examples provided in the exposure draft that will help clarify this distinction. In terms of existence uncertainty, so that's another factor to consider on recognition, and it really relates to whether the entity has doubts as to whether a liability exists. So typically this could arise if there are interpretation issues around the application of law or a particular clause in an agreement or contract. So in cases where there are existence uncertainty, the SOP proposes that one would look to the contingent liability standard, and that would require you to assess and estimate the probability of a future event occurring. So in this case, the future event would be actually incurring retirement costs. And so you'd have to make an assessment as to whether or not it was likely you were going to incur those costs or not likely or undeterminable. And then that would drive your accounting from there. In terms of measurement uncertainty, so that's different because that really relates to whether you can reliably or accurately measure the value of the liability. So it could occur in situations where the timing of the settlement of the obligation is unknown, or like when a capital asset has an indeterminate useful life. And so measurement uncertainty does not affect the fact that an obligation actually exists, but it could affect the measurement of the liability or even the timing of the recognition of the liability as well. So looking at recognition and allocation of costs, the concept of componentization may stand out a little bit here on this slide. And so for those entities that recently undertook significant efforts to adopt PS 3150, which is the tangible capital asset standard in PSAS, or even those who are familiar with IFRS, you're probably well aware of the concept of componentization in capital assets. So PSAS allows for an entity to account for its tangible capital assets on either a network basis or a component basis. So for example, an entity could choose to account for its building in components. So that would mean accounting separately for the roof, the foundations, the windows, or it could choose to just account for the building as one asset. And so the concept behind this is that is really that in the ARO SOP notes that even if an entity accounts for its assets on a network basis, it's still going to need to assess its AROs on a component basis. And so the concept behind that is that the useful life of a component could be significantly different than the entire TCA itself, and therefore the recognition of the retirement obligation should follow the component that the obligation is related to. So what's interesting here is whether the inconsistency in recognizing components between TCAs and AROs are going to cause practical application issues when the ARO standard is actually in place. And so, the fact is that PSAB is still in the early stages of the project, and therefore there's still an opportunity for these issues to be addressed. In terms of measuring an ARO, only the costs that are directly attributable to the retirement of the TCA would be included in the estimate of ARO. So some retirements may have post-retirement costs that need to be considered, such as costs incurred to monitor the asset after it's been retired. And so the viewpoint expressed in the SOP is that these costs are integral to operating and owning a TCA, and therefore they need to be considered as part of the ARO. In terms of valuation techniques in measuring the liabilities, a present value technique seems to be certainly the preferred method that comes across in the underlying paragraphs of the SOP. And so currently the SOP indicates that the valuation, though, should be based on management's best estimate of the amount required to retire a TCA. And so while a present value technique seems to be the preferred way to measure these liabilities, it's not necessarily required, or, at least that's the way the SOP is reading right now. And so at the end of the day, the result is that it's a pretty broad statement, and so there could be further narrowing of this requirement, which, could result in including at the end of the day a requirement to use present value techniques to be used in measurement of the liabilities. And so given the complexity of the assets and the calculations and costs that are involved in asset retirement obligations, no matter how perfect we are as accountants, we do have to change estimates from time to time. And so the SOP proposes that the ARO obligation would be reviewed at each financial reporting date. So essentially, the liability needs to be reviewed to determine whether additional information has come to light that would change the estimate of the ARO. So in addition to looking for new information, an organization would also review its key assumptions in calculating the liability, such as a discount rate, to determine whether there are changes in the calculation that are necessary. So as I mentioned earlier, if the change in the valuation is a revision to estimates or timing, that change would be capitalized to the TCA. But if the change is due to the passage of time, like accretion, then that change would be expensed. We do get questions from time to time generally around what is meant by directly attributable costs, as these costs can be capitalized to assets under PS 3150, as there is some judgment involved in determining what is considered to be directly attributable. And so the ARO SOP does provide some details on what could be considered costs that are directly attributable to the obligation, and so they're listed here, but the important thing to note is that this is not an exhaustive list, and so there is certainly it won't cover every single cost that could be directly attributable to an ARO. Recoveries is an area where there are some differences from the contaminated site standard. So under contaminated sites, recoveries are permitted to be netted against the liability, while under the ARO SOP, recoveries are right now being, or it's suggested that they should be recognized as an asset, so recognized on a gross basis. So when I think of recoveries, a common example that I like to think of is just insurance recoveries. And so when you think about insurance, an event, typically has occurred that's going to require you to submit a claim. And so the recognition of an asset from that claim typically follows a different recognition, process than the event or the liability that actually caused you to make the claim. So usually insurance proceeds would need to be considered as a contingent asset for a little while until there's a little bit more certainty around whether the amounts from the claim will actually be paid out. And so there's often a timing difference in which the asset for insurance proceeds can be recognized versus the recognition of the associated liability. So in addition, the SOP actually also notes that the legal right to offset a recovery against the liability does not exist in recovery situations because the counterparty to the recovery is not the same as the counterparty to the obligation. And so at the end of the day, really, the result is that, the SOP is noting that recovery should not be netted against ARO liabilities. So, and as I noted before, this really isn't consistent with the contaminated site standard, and so it's something that we hope gets explored in future dialogue, either on this project or maybe in a review of the contaminated site standard. In terms of disclosure requirements, they're somewhat prescriptive and extensive due to the complex and long-term nature of AROs. And so because of the level of professional judgment that is involved in the calculation, the SOP goes through some pretty detailed paragraphs on disclosure and presentation. And really, at the end of the day, the point is that users are going to want to know and want to understand the nature of these liabilities and the basis for calculation and information about the key inputs, such as the discount rate and stuff like that. So looking at the list of potential disclosures that's up on the slide there, the one that jumps out to me is the last one, which is disclosing the reasons for not recognizing a liability. But when you think about it, this is really referring to rare situations where an entity has an obligation but is not able to make a reasonable estimate of the value of the liability. So in these situations, you would disclose that the entity has a liability, but you would provide the reason as to why the entity could not reasonably measure the liability. And so I'm going to end up my portion of the webcast today with a quick little comparison between the SOP and what exists in Part 2 and Part 5 of the CPA Canada Handbook. So in terms of the types of obligations, so PSAS has intentionally made the types of obligations under the ARO SOP more broad than what we see in ASPE in Part 5. And it's really to be consistent with the definition of a liability under PSAS. And due to the nature of the public sector industry itself, because, governments, essentially have, and government organizations have very different responsibilities than those of the private sector. In terms of the scope of the standard, the SOP is clear that operating leases should be excluded from an ARO standpoint, whereas ASPE and Part 5 GAP are not as explicit. But generally speaking, if you have an operating lease, it would be tough to record an ARO against it, as there needs to be an asset recorded, in order for you to match an ARO against it. And then finally, in terms of measurement, the SOP is currently very broad, although it does seem to favor the present value technique, as I mentioned earlier. And ASPE in Part 5 is certainly more prescriptive on how to measure AROs, and I expect, or at least hope, that as this project moves into the exposure draft stage, that more prescriptive requirements on disclosure and measurement are included in the standard to help with the consistency in the standard and ensuring that it gets applied consistently across the sector. So with that, Rachel, I'll turn it back to you.
Thank you, Matt. I'd now like to ask you to participate in our next polling question. So do you believe that the statement of principles will significantly change the way your organization accounts for asset retirement obligations? A, yes, B, no, or C, not applicable for my organization? So while we're waiting for the results to load, just want to again remind participants that you can download the slides in the Downloads and Links section in the bottom right-hand corner of the screen. And if you joined the webcast before we were able to upload the slides, you may need to refresh your screen in order to get that link. So Matt, we do have a question here for you on asset retirement obligations. So capitalizing costs to clean up or retire an asset seems counterintuitive because these costs do not enhance the service potential and wouldn't be considered as a betterment. Why wouldn't these costs be expensed instead of capitalized?
That is a very good point, and certainly one that was actually considered in the SOP itself. But when they went through and did the analysis of, and what other standard setters have really thought about is, the cost, or what you want to do in terms of recording a tangible capital asset is really measure the costs associated with it. You're not thinking about measuring a fair value on an asset. And so retirement costs, they're an overall cost to the tangible capital asset. They're the cost necessary to enable the use of the tangible capital asset. And so they're seen as part of the life cycle of the asset. And so that's why they're added to the asset and not expensed.
Thank you, Matt. Okay, so let's see the results of our third polling question. Interesting. So most participants have indicated that it either won't have a significant impact on how they account or it's not applicable. So perhaps we'll see this change as the statement of principles evolves. So thank you again. I would now like to turn it over to our final speaker, Cindy Veinot, who is a partner in our Toronto practice, to provide reminders regarding the accounting for financial instruments and to also discuss other PSAB projects and upcoming changes.
Thanks, Rachel, and hello, everyone. So I'm going to start with a brief review of where things are at with financial instruments and foreign currency translation. I sort of feel like I've been talking about these two standards for a number of years now, and in fact, they have been out for a number of years, but this is one set of standards that have one adoption date for government organizations that previously applied Part 5 and had implemented the standards on financial instruments, and then a later date for governments and government organizations that are following PSAS. So government organizations applied in 2012, and government organizations that were not applying Part 5 actually still have about a year and a few months before they have to apply the new standards. So right now we're just right in between those two dates, which results in different accounting at the government organization level as compared to the government level, meaning a little bit of complexity with respect to reversing entries on consolidation at the government level to put the accounting back to the existing PSAB standards. So as I noted, governments and government orgs who had not been applying financial instrument standards under Part 5 still have just over a year before you have to implement the standards, but I think it's worth taking a look at the implications now, and I know many of you have, because they can be quite significant, measuring financial assets and some liabilities and all derivatives at fair value, looking for and accounting for certain embedded derivatives, no longer being able to use hedge accounting, and having to present a new statement of remeasurement gains and losses. All items that can be quite complex and certainly ones to think about as you are preparing to adopt the standards. There is one exposure draft out right now related to financial instruments to clarify some aspects of that standard. The exposure draft was issued in October, and comments are actually due tomorrow. So if this exposure draft impacts you, you still have time to send in your response form to PSAB. I'm just going to walk through the clarifications. And the first set of clarifications relates to the scope of the standard. It clarifies that there must be a contract underlying the asset or liability for that item to be included within the scope of the standard. So a receivable that arises from legislation, for example, related to CPP or EI, is not within the scope of the standard. In addition, the clarification removes a reference to lease receivables. I actually think this proposal makes the standard a bit unclear, but it was necessary because of the reference to the standard on leases. So PSG2 is the only standard in the public sector guidance that speaks to accounting for leases, and it addresses the accounting when a government or a government organization leases an asset and accounts for it as a tangible capital asset. But you could still have lease receivables if you happen to be a lessor. So if you do, I think you should be considering this guidance in terms of evaluating any potential impairment. The second set of clarifications relates to collateral transferred in connection with a derivative contract. And it clarifies that generally the transfer of that collateral in this circumstance would not result in a settlement. So if you're in that bucket, take a look at this clarification. And finally, there are a number of provisions related to transition. So clarification on what you do when you are adopting the standard, clarification on unamortized discounts or premiums related to either debt buybacks or assets that are now going to be accounted for at fair value, as well as the opening entry for derivatives that were not previously accounted for. So the guidance does clarify whether the amounts are recorded to an opening accumulated surplus or deficit position, or an opening remeasurement gain or loss account in connection with that new standard. So I'm going to move on to some other topics, and this is a bit of a hodgepodge in terms of what's been happening, but just thinking about what Lynn said at the beginning, PSAP's been really busy. So there are a number of standards where we provided more detailed content last year, and we're just going to do an update this year. So I'm going to start with the Revenue Recognition Statement of Principles. This Statement of Principles was issued about a year and a half ago now, in August 2013, and an exposure draft is expected to be produced in the second quarter of this year. So as a reminder, we already have two sections that address major sources of government revenue. So we have government transfers, which has been a source of contention since it's been issued, and we'll talk about that a little bit later, and tax revenues. We also have other standards, including restricted assets and restricted income, and there's some guidance even in financial instruments. So there is guidance in the handbook on revenue, and then revenue is defined generally in PS 1000, and there is certainly presentation and disclosure requirements in PS 1201. But there is not one overall standard on revenue that addresses sources of revenue that are not captured by government transfers, tax revenues, or those other standards that I mentioned. So this project will address recognition, measurement, and presentation of revenues that are common in the public sector. The SOP focuses on when revenue should be recognized for two main types of transactions. So there are exchange transactions and unilateral transactions. Exchange transactions are, basically what you would think they would be. They're transactions where, in exchange for consideration, the customer or the taxpayer or the resident is actually granted something. So it could be related to the sale of services, fees and user charges related to performance obligations, licenses, the sale of goods, or the sale of property. So if I think about my driver's license, that would be an example of an exchange transaction. So in exchange for an amount, I'm granted a license to drive for a predefined period of time. And in the Statement of Principles, the concept of a performance obligation is the distinguishing factor of an exchange transaction. So there is something that the government has to do and provide to the resident or the customer in the context of these types of transactions. Contrasted with those types of transactions are unilateral transactions or non-exchange transactions. So these are things like taxes, fines, penalties, and fees that don't give rise to a performance obligation. So contrasting to the driver's license that I spoke about, if I get a ticket for speeding, that would be considered a unilateral transaction. I don't really get anything in exchange for that except the obligation to pay an amount to the government. And in terms of determining when those types of revenue should be recognized, authority and a past event giving rise to a claim on economic resources are key things to consider in terms of unilateral transactions. A number of comments have now been received on the Statement of Principles, and just as a reminder, all the comments that are submitted are available publicly on PSAB's website, and I'm just going to highlight a few of the common themes that came through in the comment letters. So the first issue is collectability. The SOP as drafted included some wording that implied that unless an amount was inherently uncollectible, it would be recognized as revenue and a receivable. And many comments noted that that's not an appropriate threshold for recognizing revenue and recognizing a receivable, that there should be some expectation of collection. And some actually pointed to the measurement criteria or the recognition criteria in the tax revenue standard, which indicates that the revenue and related receivable should be recognized at net realizable value. The second comment that came up a number of times was determining whether a transaction has a performance obligation. And I think, that's a logical comment to expect, because if you're going to have a standard that actually has different criteria depending on which type of transaction you have, then there's going to be an issue in terms of determining which transactions go in which buckets. And so one of the examples that was highlighted was royalties. So we often see situations where government earns royalty revenue from the use of land in connection with transactions such as mining transactions. So the question is does that transaction have a performance obligation or not? Is the government obligated to allow the counterparty to the transaction to use the land and to mine it for a specified period of time? And in that case, in that situation, is there a performance obligation to account for? And the third comment that came through was on accounting for license revenue. The two choices, if you're thinking about a license, are typically, you recognize revenue at a point in time, typically when the license is granted, or you recognize revenue over time, so over the term of the license. If we think about what kind of licenses government issues, we could think about things like spectrum licenses that are issued to telecommunications companies, or licenses for the use of data. Of course, there's many other kinds of licenses as well. And so you can look at those licenses and say, well, the license is really akin to an operating lease. And in that case, perhaps it makes, it's more appropriate for the licensed revenue to be recognized over the term of the license. And maybe that's the case for something like spectrum licenses. Or you might say that actually it's more akin to a sale. And once the license term begins, then that's the appropriate time that revenue should be recognized. Again, those are very different answers, and they result in very different accounting in terms of how when revenue could be recognized. Okay, we're gonna move now from the credit side of the books to the debit side of the books and speak to an exposure draft that was issued on assets, contingent assets, and contractual assets. So this exposure draft was issued just in August of 2014, and it's intended to provide guidance for applying the definition of assets set out in Financial Statement Concept Section 1000, as well as providing general disclosure standards for assets. So the standard further clarifies the characteristics of an asset, including all three types of assets, so an asset, a contractual asset, and a contingent asset, and providing definitions. And it also lays out the disclosure requirements for assets not capable of being recognized. So if you think of things like heritage assets or crown lands, intangible assets that currently are not recognized under PSAS, those would be types of assets where there is now disclosure being proposed. The comment period for this exposure draft closed in November, early November of 2014, and final standards are expected in the second quarter of this year. Based on the exposure draft, the section is expected to apply to fiscal years beginning on or after April 1st, 2017, so a couple years away. And of course, earlier adoption is encouraged. So we'll move on now to another exposure draft that was issued in August, and this relates to restructuring transactions. So this exposure draft was issued on August the 6th, 2014. So August was a busy month, and the comment period closed at the end of November. So the standard setters were busy before August, and we've been busy in November writing our responses to both of these documents. So comments are being considered, and a final standard is expected again in Q2 of 2015. So this project will address the initial recognition and measurement of assets and liabilities that are transferred in restructuring transactions, as well as the related presentation and disclosure issues. So the main features of this document include clarifying what's meant by restructuring, understanding the characteristics of a restructuring transaction, and determining how to recognize and measure assets liabilities that are transferred, as well as the related costs. The expected application date is for fiscal years beginning on or after April 1st, 2018, although again, earlier adoption is encouraged. The definition of a restructuring transaction is on the screen, and below it we've outlined some of the key characteristics. So a restructuring transaction is non-purchase in nature. It relates to the transfer of an integrated set of assets or liabilities that are not random or unrelated. So we're not talking in this scenario about transferring a piece of land or a single asset. We're really talking about transferring a set of assets. And along with that, the transfer of a program or operating responsibilities related to those assets and liabilities transferred. And so I think one of the things to be clear on is we often talk about restructuring activities in the context of downsizing, which involve, the termination of employees and cancellation of leases and things like that. And that's not the type of restructuring that we're talking about in this standard. So then if we think about what the accounting implications would be, the standard notes that the transfer is recorded by the transferor and the transferee at carrying value. So that would typically make sense. We're talking about transactions that are non-purchase in nature, and many times they would not involve the exchange of any consideration. What was interesting to me is that the impact from a revenue and expense perspective is proposed as reflecting that through the P&L. So in other words, the net effect of the transfer, along with, if any compensation is considered for any reason, is recognized as revenue or expense. So if we think about a typical transaction where there's net assets being transferred, then the transferor is going to credit the net assets and debit an expense. They're going to recognize an expense related to the transfer. And the recipient is going to debit net assets in their account, and they're going to credit revenue. So in connection with this document, we commented on the treatment in connection with common control transactions where two government organizations might be amalgamated. And certainly we've seen that many times in Ontario in the hospital sector where two hospitals are amalgamated into one organization. And amalgamations are listed as a type of transaction that would be included under this title of restructuring. And in my experience, amalgamations like that of two organizations that were historically under common control would be treated using what we refer to as a continuity of interest method or an as-if pooling. And the financial statements would be presented as if those two organizations had always been one, in which case, the assets and liabilities basically just get added together and there is no revenue or expense recognized as a result of the transaction. So we'll see how this unfolds in terms of the final standard being produced. Okay, we're going to change gears again, and I'm going to spend a few minutes talking about the joint not-for-profit review. So this topic will be of interest to those on the call that are following PSAB, but with the 4200 not-for-profit series, so typically government not-for-profit organizations. So as a brief recap, the Accounting Standards Board and the Public Sector Accounting Board are working together to improve not-for-profit standards to better meet users' needs. As you remember, when all of the change in standards took place in Canada, government not-for-profits went the PSAB route, plus the 4200 set of standards as an option, and private not-for-profit organizations went to Part 3, which includes all of the previous not-for-profit standards, and they use ASPE as an underlying base. So this joint task force issued a statement of principles in April 2013, and they really received an unprecedented amount of response, which is great because it's good to see that all of you were engaged in terms of taking a look at the proposals and providing feedback to the boards in terms of how these are going to impact your organization. And as you might remember, the proposals for government not-for-profits were largely to eliminate the specific NPO guidance and have government NPOs follow full PSAS. So I know across the country, in some jurisdictions, government has already made the decision to have government not-for-profits follow full PSAS, but in some jurisdictions, organizations are still following PSAS plus the NPO, the 4200 series or the NPO standards. So that SOP for government not-for-profits largely was moving everyone to full PSAS. We did prepare a document that summarizes the feedback that was received, and you can find that document in this very long link that's on the screen in front of you. So there is a next step in the process, and there is a meeting scheduled in March 2015 to discuss more about understanding users' needs, to talk about whether there is a need for symmetry between both sectors. So part of the conversation I know that's been taking place is, are organizations, whether they're government not-for-profits or private not-for-profits, actually competing against each other in terms of donations and things of that nature? And so is it important for their financial statements to look the same or follow the same types of principles? And then finally, a timeline for the project will be discussed. So if that is an issue for you, then stay tuned to that. We're going to move now on to those organizations that are not following the 4200 series. So everybody on the line that's not a government not-for-profit and following full PSAS, this topic will probably be relevant for you. And it's the post-implementation review of Section 3410, which is government transfers. As you're no doubt aware, the new government transfer standard came into effect on April 1st, 2012, after many, many years of debate, after a few re-exposure drafts, and after much discussion. So the standard has now been applied, and PSAB is now undertaking a review to better understand how practitioners interpreted and applied the standard. So they're really looking to determine how much consistency and how much inconsistency is out there in terms of how the standard has been applied. And we've certainly been involved in many discussions over the last few years and understand there to be a fair degree of inconsistency in terms of interpretation. There are a number of hot topics with respect to PS 3410 or government transfers, but I think the hottest one is how recipients account for capital transfers, so amounts that they receive that are to fund capital assets that they purchase or construct. And, the two positions that one may say are at the end of the continuum is that in one case you determine that you have a liability, and that liability actually gets drawn down over the life of the asset, typically, or you determine that once you actually have constructed the asset or purchased it, that the liability gets recognized at that point. So that's one area that PSAB is very interested in receiving input from you on in terms of how you looked at that and how you applied the standard. But in addition, they're looking for input on how the authorization guidance is being applied in a few different contexts. So multi-year transfers, transfers that are subject to authority to pay or approval of appropriation provisions, which we see in many multi-year transfer agreements, and also situations in which the same transfer has been provided to the same recipient for a number of consecutive years. And finally, PSAB is looking for feedback on how the distinction is being made between stipulations and eligibility criteria. And that decision can certainly affect the accounting for both the transferor and the recipient. The responses to the request for information are due May 15th, 2015. So there is definitely time to get involved, and I would strongly encourage any organization that adopted the standard to take a look at the request for information and see if you can provide feedback that I believe is really tremendously helpful to the standard setting process to enable the standard setters to really take a look and see if the standard is being applied as it was intended or if there are any changes that need to be made. I'm not saying that's necessarily going to be the outcome, but I think it could be something that would be considered. We're also planning to respond, and certainly we'd be very interested in having a discussion with you regarding your feedback to PSAB. So please reach out to your engagement team or any of us on the call if that's of interest to you, and we can set that up. And as noted, there is a link to the response on this slide. Okay, now we're going to move to talk about thinking about retirement. So, which is, you know, I was thinking that I'm sitting here in like negative 15-degree weather, and it would be nicer to be in Florida. So maybe that'll happen when I'm retired. But for now, we're going to provide a brief update on shared risk pension plans. And we did spend quite a bit of time talking about this type of plan last year. So this year, we're just going to provide a brief update related to some standard setting activity or what I would call accounting discussion activity around these types of plans. And I think this topic will probably be of interest to everyone, both with respect to how you actually account for this type of plan, but also to understand the plans, because as a member of a pension plan, this type of plan may be considered in the future. So we're going to focus on the discussions that have been held by the Public Sector Discussion Group and the discussions that are upcoming by them related to this topic. So to put this in context, let's review the typical characteristics of such a plan. So these plans have characteristics of both defined benefit plans and defined contribution plans. So funding is typically shared by the employer and the employee, and it's set to meet certain risk management goals. So for example, there's, you know, the models are run by the actuary to determine that there's a 97, 98, whatever the percentage is, chance that the contributions as set will be sufficient to pay out the targeted benefits. But there's a chance that the funding levels are not going to be sufficient and a funding deficit recovery plan will be required, which could result in increased contributions, but only to a predetermined cap, or could result in decreased benefits. The actual benefits paid or payable to a retired or terminated member are based on a targeted formula, but are not promised. And governance of these types of plans is usually by an independent board of trustees with representatives from the employees and the employer. So this type of plan, as I noted, has characteristics of both a defined benefit plan and a defined contribution plan. And as you know, the accounting for those two different plans is very different under current GAAP. So the Public Sector Discussion Group did discuss this issue in terms of what type of plan is this, and two opposing views were discussed that are included here on the screen. So view A is, you know, the plan's not a defined contribution plan because the employer is exposed to potential variability in the contributions. While it may be clear right now that contributions are set at 10%, there is a chance that contributions could go up if funding levels are not sufficient. And when the employer has that type of residual risk, then the plan by definition is a defined benefit plan. The contradictory view is that the plan is really more akin to a defined contribution plan, and while contributions may vary in the future, the potential that employer contributions can increase is both predetermined and capped. And a defined benefit liability does not exist, as the employer's sole obligation is to make the specified contributions. At the meeting where this was discussed, the majority of the members voiced support for view A, so that it is actually more akin to a defined benefit plan than a defined contribution plan. Going forward, two things to keep an eye on. First, at the December 2014 meeting, PSAB approved a project on employment benefits. And in their discussion, there's a phase 1 and phase 2, and phase 2 does specifically say that the intention of the project is to address these types of plans. Phase 1 of that project deals with other things like discount rates and amortization of actuarial gains and losses and some other topics. The second thing to note is there is another discussion on this topic planned at the next Public Sector Discussion Group with respect to measurement. And just speaking of the Public Sector Discussion Group, that's the last topic that I'm going to speak to. So the Public Sector Discussion Group is just a discussion forum. It doesn't provide any authoritative guidance. its purpose is to address issues arising on application of the PSA handbook. So similar in nature to the same type of committee that exists for the private sector or the IDG that exists for IFRS. And anyone can submit an issue to the public sector discussion group. So on this slide and the next, we've listed the topics that were discussed in 2014, and there were 2 meetings during the calendar year. And if any of these topics are of interest to you, you can find the meeting minutes on the Financial Reporting and Assurance Standards Canada website under the PSAB tab or under the blue tab. And I'll just touch on a couple of topics on each of these slides. So on this slide, the first item relates to presentation of budget information. And as you know, if you're following full PSAS, then you have to provide budgeted information on the face of your financial statements with few caveats. And the discussion was really related to government organizations and what happens if you have a change in your funding midway through the year, and that changed funding is what management is actually now accountable for. The standard requires you to present the budget as originally planned. So do you still put in that first budget, or do you actually put in and disclose a budget that reflects the changes that have been made? And in general, there was support to include the original budget, and then there was encouragement to actually provide an explanation as to the reasoning behind the significant variances. And I'll just point out as well on this slide that the very last topic on this page is a topic that was discussed with respect to assets that are no longer in productive use, which Lynn and Matt touched on earlier. And on this next slide, I'll just touch on the last item, which is a topic that relates to government transfers and whether there could be a situation where the transferring government can have a constructive obligation that it should account for related to a transfer, even if there's not clear authorization of the transfer that would meet the criteria in Section 3410. And I would say there wasn't really a predominant view expressed by the committee on this issue, and it was noted that this type of issue would be very facts and circumstances dependent. One more note just about government transfers is that there were a significant number of discussions on government transfers during the 2013 meeting of the Public Sector Discussion Group. And while we've only included the 2014 topics discussed in this webcast, all of those meeting minutes from 2013 are on the PSAB website, and you may find them to be a useful reference. And finally, the next meeting of the Public Sector Discussion Group is tomorrow, and we've included a list of the topics that are on the agenda. So as you can see, just 4 items. More discussion on the presentation of budget information. And as I had mentioned, there will be another discussion on shared risk pension plans and specifically about how the net assets of that type of plan are recognized in the financial statements. And then a couple of broader topics relating to the value of statements of recommended practice, or SORPs, and also standard setting and the public interest. And with that, Rachel, I'll turn it back to you.
So thanks again, Cindy. Certainly a lot of projects and activity related to standards. I'd like to now invite participants to participate in our final polling question. So which of the following PSAB projects do you believe will have the greatest impact on your organization? Restructurings, revenue, assets, contingent assets, and contractual rights, or none of the above? So Cindy, perhaps you can answer a question that's come in from the audience. So the question is, how different is the revenue statement of principles from the new revenue standard that has been issued under IFRS? Well, there are definitely some differences. I mean, it's been there's been a lot of revenue guidance issued, and certainly some things are the same. So the focus on identifying things like performance obligations are the same. I would say some of the discussion that's been happening around licenses in terms of the comments that came in
in the statement of principles are similar to the discussions that are happening now with respect to IFRS 15, which is the new revenue recognition standard that's been put out. But there definitely are some differences because if you think about the private sector, they typically don't have unilateral transactions. And so that's a big distinction that the SOP will deal with from a public sector perspective. That won't be an issue for the private sector.
Perfect. Thanks, Cindy. So now let's look at the results of our fourth polling question. I think this is our most conclusive response today. So almost 50% of respondents have indicated that the revenue project will have the most impact. So now we're moving into our question and answer period of our webcast. I will remind you that if you haven't submitted questions, you still have an opportunity in the next few minutes. So, however, before we move into the question and answer, I just want to highlight that we do appreciate your feedback, and we want to draw your attention to a survey icon at the bottom right-hand corner of the screen. So please click on that icon to complete a survey on today's webcast. We do take these surveys seriously, so continue to send us your suggestions, and feel free to also let us know what we are doing well so we can keep it up. If we don't get to all the questions today, particularly if they are regarding specific fact patterns for your organization, I would recommend that you discuss your questions with your Deloitte partner or Deloitte contact so that we can help you resolve any questions or concerns that you may have. So the first question that I'm going to ask, I'm going to address it to Matt. So what happens if an asset retirement obligation is incurred near the end of the useful life of an asset, and as a result, booking an asset and ARO would significantly distort the net book value of the tangible capital asset? Would this potentially result in an impairment and write-down?
So, I mean, that's a good question. What I would say is, first of all, if you're going to have an ARO that is recognized, I guess, at the end of the useful life of an asset, essentially you would capitalize it to the asset, and it would just have to be amortized over the remaining useful life of that asset. So you would not only see a big bump in your capital asset, but you would also potentially, see a huge increase in your amortization expense. The SOP does actually, suggest that it just has to be in a rational and systematic manner. And so, if there's only like 1 year left or just a couple of years left, I mean, I think depending on the nature of the ARO, I mean, you could potentially look at taking an expense in a given year. But again, that's going to depend on it's going to depend on the nature of the ARO and what caused the ARO. So looking back to what was actually the cause of the ARO, would be an important part in this because, it's important not to confuse the concept of an ARO with impairment because, impairment suggesting that, something's happened to the useful life or the service potential of an asset. And that's not necessarily, what an ARO is. An ARO is more about, incurring an obligation to clean up the asset. And so typically you would when you have an asset, you would know of those costs, at some point throughout the asset, maybe even at the beginning of the useful life or when you've recognized the asset. So the end result is as well that, there is a standard actually that's out right now, or not a standard, sorry, there is a project that Lynn talked about earlier on impairment of assets that is under consideration from PSAS as well. So, I would pay attention to that and see if there's any guidance that would be provided in that, as well as, also considering the contaminated site standard as well.
Perfect. Thanks, Matt. I'm going to direct the next question on related party transactions to Lynn. It appears that there is a wide variety of recognition and measurement options under the proposed related party standards. Will the proposed standards actually result in consistent reporting of similar transactions?
Sure, Rachel, thank you. It's early days yet, and I think many of the comment letters on the re-exposure draft identified a number of the challenges in providing so many options. I think it's highly possible and probably highly probable that similar transactions may be reported differently by different organizations. I'd even suggest that it's possible for the same organization to report similar transactions differently. For example, if you had allocated costs from two different entities where it's possible to provide a reasonable estimate in one case but not in the other, in one case you would record the allocated costs at fair value, and then in the other case you wouldn't record them at all. I think we as auditors are going to struggle to audit the recording of these transactions, particularly where they're not at the exchange amount or the carrying amount. It's going to be very difficult for management to provide evidence of fair value, I think.
I would agree with that, Lynn. I'm going to move on to the next question for Cindy. So what is the reasoning behind hedge accounting no longer being allowed?
Oh, good question. So I think it's a couple of things. One, I think hedge accounting historically has been very complex to apply. And so I think eliminating that complexity factored into it. I think a big portion of it was having now a separate statement for remeasurement gains and losses and having derivatives at fair value. So keeping the unrealized gains and losses out of the main statement. And so it kind of separates that out. And so there was, I think, a thought process that there's really not a need for hedge accounting anymore because of the statement of remeasurement gains and losses. But I think it's important really to look at that for your organization because things like hedging future purchases of like capital assets, things of that nature will really have different accounting than they currently do if you're hedging those types of purchases. So looking at current GAAP versus what will be required when you apply the new standard.
Okay, so I have another question for you, Cindy, so I'm not going to let you off the hook too soon. How do I submit an issue to the public sector discussion group? Okay, so if you go on, again, that Financial Reporting and Accounting Standards Canada website, and you go under the Public Sector tab, there is a whole section on the PSDG, and there's instructions there in terms of how to submit an issue for discussion. One thing that I would just note is that they do request a fairly long lead time in terms of when issues are submitted as compared to when the meeting takes place. So I think it's like 6 to 8 weeks. So take a look at that. The meeting dates for the 2015 meetings are also on the website, so you can certainly plan in advance if you want to submit an issue. And then there's instructions on who to send it to. Perfect. So another question has come in for Lynn. You mentioned that the present value technique should reflect the timeline to remediation. What did you mean by that?
What I meant by that is that any discount rate you choose should reflect the timeline to remediation. So that's to say that if you expect you have to remediate the site in 20 years, then your discount rate should reflect a 20-year time horizon. So, for example, in an ideal world anyways, this may not be as easy in practice, using, for example, a 20-year bond rate. Not everybody issues 20-year bonds, but obviously there would be some judgment in trying to figure out what the impact on that discount rate is when you're looking at a 20-year time horizon. Furthermore, in our view, although it's not specifically stated in the guidance, we'd normally expect the discount rate to reflect the risks associated with the entity. And that's to say that the borrowing rate, you'd use the borrowing rate of the entity and not a notional risk-free rate. It's important to note that the risk associated with the entity isn't necessarily the risk associated with the parent government. And so, if you're an OGO, you aren't necessarily using the same rate as the government itself would use.
Thanks, Lynn. Next question is on asset retirement obligations. So for Matt, what happens if an asset retirement obligation is identified after the asset has been put into use? How would the accounting work if the obligation didn't exist at the date that the asset was put into use?
Yeah, so I mean, that's fairly similar to the other question in the sense that if an asset obligation is identified, let's say halfway through the useful life of an asset, essentially, you would record the obligation and then amortize that asset over the remaining useful life, or in a rational and systemic manner. So essentially, you would have you would amortize that over the remaining useful life of an asset. So you would have a debit to your capital asset, and then your amortization expense is going to be a little bit higher over the remaining useful life of the asset.
Perfect. So the next question is, do you know if the government transfers project will look at the matching of capital revenue to depreciation as is required by the province of British Columbia?
So I can take that one, Rachel. So I don't think the post-implementation review is designed necessarily to reevaluate the standard, but I think information like that in terms of what BC requires from a legislative perspective, what Ontario requires from a legislative perspective, is all useful information. And certainly that concept of matching, which, from an accounting perspective, sometimes it gets a bad rap these days, was definitely an issue that was raised by the respondents to the not-for-profit SOP. That it's very important in terms of how they present information. So, undoubtedly that issue is going to get some airplay in terms of this post-implementation review. So I would encourage you, if that's an issue for you, to complete one of those forms and send them in so that all of that context is included in the discussion.
Perfect. So that concludes our question and answer period. So thank you again to all of you for joining us and to our speakers. We hope that you found this webcast helpful and informative. If you want additional information, please visit our website at www.deloitte.ca. This concludes our Public Sector Accounting Standards Update, Bringing Clarity webcast.